I don't know if this is your experience, but if you have a low risk tolerance, the first time you invested probably felt like you had jumped onto a bucking wild horse. You were whipped around, thrown off, and probably trampled. You suffered losses. And you decided that going forward, you would only ride mild ponies. You would only put your money in low risk investments. This will not be in your best interest in the long term. Listen to hear why. Every day you get out of bed and your feet hit the floor is like you marching towards your future. There is a pace that you need to keep for you to achieve your financial objectives. This is because retirement or your children's education or some other goal is edging closer and closer to you every year. The pace at which you put your money aside and the pace at which your investments grow needs to keep up. When you narrow your attention on only safe investments and avoid high-risk investments, your returns will fall short of the target you are aiming at. Either you will have to ratchet up your savings so that you can invest more, or you will have to push your financial objectives further into the future and wait longer before you can achieve them. Let me show you the effect of low returns on your investments. Imagine that you want to put aside 10,000 shillings every month for 20 years. If that money grows at 6%, your nest egg will come to about 4,600,000. Suppose now that you take a bit more risk and your returns rise by 1% so that your investments grow at 7%. In 20 years, you will have amassed 5,200,000. And if your returns are 10%, you will have 7,200,000. Those additional percents can make the difference between you having the money to pay for your children's university or you having to struggle or even take debt to pay for them. There could be an alarm going off in your mind right now and you are thinking, hold up, something seems off. So, am I whipping you up to invest contrary to your risk tolerance? By no means. This is what I'm trying to set right. We sometimes assume that there are 3 risk-tolerant species of people: high risk, moderate risk, and low risk people. We then go further and say that high risk tolerant people can invest in high risk investments and low risk tolerant people should invest in low risk investments. What comes from this assumption is that if you are a low-risk investor, you would be advised to go for money market funds and government bonds. People with high risk tolerance would have broader options to invest in stocks and other speculative investments. This approach would be mistaken, chiefly because people do not fit so snugly in neat boxes like that. Risk tolerance is not like a checkbox where you tick whatever category you fall under. It is more like a sliding scale. This is where there are many levels of risk tolerance and you can fall anywhere on that scale. So don't think black and white but shades of gray. No person is purely low risk and therefore you should not invest purely in low risk investments. Let me briefly break down why this will not be the right move for you. Many times, the returns on a low-risk investment might appear acceptable. However, if you were to take a closer look, you would find that they do not make the cut, and the culprit is inflation. If you are saving up for a holiday or any other short-term goal, inflation won't matter. However, if you are building a stash for your retirement or any other long-term objective, then inflation will have a massive effect on your ability to achieve that goal. The returns need to overshadow inflation. Otherwise, there is a considerable chance that you will fall short of your objective. Consider this. At the moment, the inflation rate in Kenya is 9.2%. This is quite high. Suppose you put your money in treasury bills, which are the safest investments. You will receive between 9.7 and 10.7% returns. When you consider inflation, you will effectively receive between 0.5% and 1.5%. Those returns won't grow your assets enough for you to live off them and become financially independent. For purposes where you need enormous amounts of money, you need your investments to grow substantially. If you only lean on low-risk investments, you might be lulled into a false sense of security until you're woken up by inflation. Then those returns shrink and become mediocre. When you bring taxes and management fees that investment companies charge into the equation, then your returns will be meager, a pittance. In fact, your real returns might be negative. And with negative returns, you are essentially saving and investing for the benefit of investment companies and the government. You will be getting the short end of the stick. Another reason masses of people have been driven to low-risk investments is they seem to have the highest returns right now. Therefore, it only makes sense that you will direct all your savings into those products. That wouldn't be wise, however. The grounds for this is that it is safer for you to invest small amounts and over a long periods of time in high-risk investments. It will be very risky for you to hold off now and then later. When the high-risk investments are doing well, you pick one to put a large amount of money in all at once. That will be like jumping into a murky pond that you are not familiar with. To understand, let us unravel how you would make money from shares. You can get returns through dividends, but those tend to be almost negligible. The source of most of your returns will be the difference between the price you sell the share and the price that you paid for them. So, the simple mission is for you to buy the shares when they are low and sell them when they are at their peak. When you routinely buy small amounts of shares, you'll find that the average price that you pay over time will be lower than that if you tried to time the market. This is called dollar cost averaging. It is a practical and successful way to make sure that you will capture those returns that come from the increase in the share price. Therefore, the approach where you figure that you would rather not risk any of your money right now might play out to be quite risky later. You might hope to buy your time until shares start to gain value before you move some of your money in that direction. However, getting this timing right is practically impossible. Most of those gains are going to happen at the beginning of the upsurge. Meaning, if you do not already own shares, you will miss the train and end up buying them when the price is already high. So, with all of this in mind, how will you make sure that you are not going outside your risk comfort zone? The solution is to first understand how risk works. Risk is measured by the variance of the returns. So, a low-risk investment has very little variance or fluctuations. If someone promises you 9%, then you can be pretty sure you will get 9%. On the other hand, when you have a high-risk investment that offers 14%, you can't be sure that you will get the 14%. There are times you will receive, say, negative 10%, and there are other times you will get, say, 40%. Over the long term, on average, the returns will come close to that 14%. But in the short and medium term, there will be a lot of fluctuation. Let me use the example of where people many times unsuccessfully chase high returns, and this is crypto. I'm not suggesting that this is one of the places you should put your money. It is just to illustrate my point. When you look at the monthly returns over the past 10 years, you will see a lot of variation. There is a lot of green and a lot of red, and it is all random. So random to the point that if someone told you that they knew what the returns would be next month, you can confidently assume that they are guessing. This is an extreme example just to illustrate how risk works. Therefore, when you say that you have a high risk tolerance, it means that you are easy with an investment that fluctuates in value a lot. If you woke up and found that your investment is in the negative, you wouldn't lose your mind and sell everything. You will be serene enough to know that this is how risk works. On the other hand, if you have a low risk tolerance, you will want your investments to have a low variation. Otherwise, you will sleep like a baby where you wake up kicking and screaming. How then can you, a person with a low risk tolerance, own high risk investments without having panic attacks? This is possible because investments are not perfectly correlated. What does this mean? It means that even though investments have variations, two investments will not fluctuate in the exact same way at the exact same time. They will not swing upwards with the same amount at the same time, neither will they swing downwards at the exact same time and with the same amount. Both investments might be high risk, but there is a chance that when one has a negative return, the other one will have positive ones. These positives and negatives will balance each other out. Let me use an illustration. Imagine Kenya Railways went public and sold their shares on the stock market. Also imagine Kenya Airways shares were still being traded. If, for example, the pilots went on strike during the holidays, this would be bad news for Kenya Airways and the share price is likely to fall. In contrast, it will be good news for Kenya Railways because the airline's customers will be forced to use the SGR. Because of this, the price of Kenya Railways shares would rise. If you owned shares in both companies, the fall in the value of Kenya Airways will be sort of cancelled out by the rise in the value of Kenya Railways. In this example, your risk would not be as high as if you only owned the Kenya Airways shares. Owning both at the same time reduces your total risk because they are not perfectly correlated. This is how you can own high risk investments without losing sleep, even if you have a low risk tolerance. Your portfolio will mostly have low-risk products. When you add some high-risk investments that are not perfectly correlated, your overall risk will still be low. Regardless of your risk tolerance, it is possible to have a mix of high and low-risk investments that will give you the highest possible returns but won't take you out of your risk comfort zone. What can you do to put these ideas to use? The first step is to take a risk tolerance test. You need a type of test that is going to give you a number on a scale. The best ones have many questions that test what risk level you prefer and test your financial knowledge. The result will be a figure. The test can then use that figure to put you in different risk categories. But the important thing is to have that number. You can then use this number to get an approximation of the mix of high and low risk investments that will work for you. Let us say that you got a risk tolerance of 47, which on some scales is the highest number. If you have 26 years or more until you retire, you could comfortably invest 90% of your savings in shares, 6% in bonds, and 4% in money market funds. On the other hand, if you have a score of 0, which means you have a very low risk tolerance, you will invest 70% of your savings in shares, 18% in bonds, and 12% in money market funds. If your tolerance falls between any of these two extremes, you will adjust the percentages appropriately. In this example, I assumed that you have more than 26 years to achieve your goal. If you have less time, the proportions will need to be adjusted. The thing to note is that you never invest all your savings in one thing. That will not be the best use of your money. First, get a number to represent your risk tolerance and then work with a professional to pinpoint the perfect portfolio for your circumstance. Exclusively putting your money in low-risk investments will keep you from achieving your financial objectives. Inflation will devastate you, and later if you try to move into the high-risk investments, you are likely to get the timing wrong and end up taking losses. Keeping in mind that risk comes from variations and no two investments are perfectly correlated will help you know how to comfortably invest some of your money in high-risk investments. The first step is to take a good risk tolerance test and then work with a financial professional on how to allocate your savings. You will end up with a low-risk portfolio that gives you the ability to enjoy some of the returns from high-risk investments. You will have the best of both worlds. Putting your money in high-risk investments does not have to feel like riding a wild horse. Use these lessons and it will feel like riding a team one. You will make good progress on your financial objectives without being thrown off.